I will let you know when we are live. All right. So we should be live now.
Perfect.
Welcome back. Looks like you are traveling. Where are you off to?
I'm on a Mexican cruise on Norwegian Cruise Line. We just pulled into port here in Puerto Vallarta.
Sweet. Well, enjoy your time there. So I only got you for 15, 20, maybe 30 minutes. We'll see if the Wi-Fi holds on. Today's topic for you is the evolution of an investor. And for
hmm
those who haven't seen your content, where can they find you?
The on YouTube it's at W2 to Freedom. On Instagram it's the same thing at W2 to Freedom.
Sweet. Because you went from a W-2 to freedom. And in that process, you evolved as an investor, similar to how I did. We both made similar growth patterns and similar mistakes.
Mhm.
Let's talk about that. What are your thoughts if you could break it out into a few different stages? What are the different stages of an investor from starting to now being able to go on a cruise and do whatever you want?
I think the first one, this is for everybody, it's a wannabe investor, meaning you're stuck somewhere in life. You have what you have, but you want something more. That was my wannabe phase. And then at that point you're like learning, educating, building your cash and everything to be able to become an investor. Then I got into the first time investor called rookie investor level. That's where I got my first house hack and started investing incrementally and out of state. And then after I got that proof of concept and had more money coming in from the W2 job, that's when I was in this massive expansion phase. So and now I was buying, 5 to 10 properties a year kind of thing. And so that was like mass expansion. Within that, to expand obviously requires a lot of time, effort, and money, and partnerships. Some of that's debt, some of that is equity. So then that was, probably 5 years I was in this mass expansion phase. Then as I left the W2 world, then it was shifting into more selective and strategic projects. And then now I'm in more what I'll call the pruning phase. And I'm really downsizing and trying to have my, what I call life by design, where I'm being able to spend my time more where I want to. So to do that, there's a lot of things that I've had to unwind that I had been building up. And a couple of these examples would be like partnerships. So, to grow fast, I was doing some debt partners and some equity partners. So 3 out of the 4 I ended up decreasing or ending those partnerships to simplify. So I only have one set of books, or I should say two, one partnership and then myself. But before I had 3 different incremental groups doing the books for the hunting for the properties, managing the bank accounts, managing the property managers, all that kind of stuff. Which, when you want to do the travel and live life by design, that becomes cumbersome. So the last like 2 years, I've been really pruning away uh, the the flock, if you will, to streamline everything down to where my motto has been less is more. So less partnerships, less properties, such that the properties I do have provide more free time for me.
Wait, and when you're on the very beginning, like so let's say you're
Mm.
just in the wannabe stage, what's the biggest step for someone there to take to get to that next stage? Because arguably that's the hardest step. I mean, it's harder to get from nothing to something than it is to get from something to buying 5, 10 deals a year. In my experience, anyway, it was easier to buy a bunch than it was to buy the first one.
Yeah, it like sometimes it's almost easier when you don't know what you don't know. So I don't know if that was your case, but I know when I bought my second property was 11 unit. I didn't even know what commercial was, but I just went and did it. So which comes to answer your specific question is from 0 to 1 or zero for you, it might have been 0 to 20 on your first deal. It is the number one like baseline thing is action because most people think about it, talk to people about it, say they're going to do something, but none of that is actually doing the thing. taking the action. So for me, that was the number one thing. And, over the last, because it's been 10 years now since I bought my first property, that's been my number one thing that has gotten me to today is just taking massive action incrementally over time, and it just snowballs on itself.
And what is that action that they should be taking? Because you can
Hmm.
say go do more action, do more stuff, but what's the
Hmm.
actual stuff?
Hmm. So for me, it was committing that, hey, I actually want to do this, right? So, so part of that was I got educated, but not, the thing. Education is super important, but not getting hung up into that and wanting so much information before you make the move. So, getting the education, getting around the right people, saving money so that you can actually buy something when you do find one. And then what I see, since I'm on the agent side, you're on the agent side as well. When I'm working with clients, the perfect deal will be there. They've done the education, they're working with the right people, they have the money, but they figure a way to not do the deal. And you're just like, we've been talking about this the whole time. Just take the action. Just sign the contract. So the biggest, I would say that was the biggest thing is um, getting the education, getting around the people, and then when the deal comes in, and saving the money, when the deal comes up, actually moving forward with it and not putting your own self-limiting barriers in front of you to not do the deal.
When I was getting started and I had the best deals that I found, no one wanted to buy them. I ended up buying all of them eventually. But what I didn't understand back then, I'm curious your take on this. What's stopping people from pulling the trigger and actually following through, doing the action? Because if you have the deal and you have the loan, you
Mhm.
have the money down, why wouldn't they sign?
It's in literally, I continually face this like almost monthly, it seems like, because when I'm working with clients on helping them build their portfolio up. And it's just that some of they're just scared inside. They haven't done it before. They're nervous about taking this risk. And that's usually what it is. It's like, you know, it's a no-brainer deal, but they haven't done it before. Or they have somebody else saying, "Are you sure you should do this? This seems really risky." And they put more value on that other person's opinion than their own opinion and just, take the jump.
What is the fear of?
Fear of failure, I think, is the main one I see. Obviously, the next one would be fear of losing money. Um, so those tend to be the two things, and um, the other one could be the fear of making the right decision. And so they end up trying to continue to get more and more and more information to make that decision, and ultimately, the more information you have, it's not necessarily going to make a better decision. Because, if you do the due diligence up front, that's going to get you like 80, 90% of what you need to make that decision.
In that situation, because there's people that'll watch this eventually. I mean, one of the 50 people, and they're gonna be like, well, I haven't done this before. I don't want to fail. What would failure actually mean though? Because if you bought the property, does failure mean you had a month of negative cash flow? Does it mean you lose the property? Does it mean it doesn't hit your projections? Like, what does that actually represent? Because people like to throw that word around,
Mhm.
but I don't think they actually quantify what that means. Because like in my world, a failure might mean I have total loss of the property, but I mean that'd be more than a failure. That'd just be catastrophic. Like
Right.
maybe a failure is not hitting your pro forma, or you project for 1,000 a month cash flow and you only hit 600 or 400,
Mhm.
or it breaks even for a year. But
Mhm.
is that even really that bad if it gets you on the property ladder? I don't think so. If you're off on your cash flow a little
No.
bit.
The It's actually, I like to say this, like, talking in letters or talking in numbers. And I think the failure is more about letters and not the numbers. So, if you put in 25,000, like for my first deal, I think it was around 25,000 as a house hack. It wasn't for most people when I'm working with them for client side, it's not necessarily the money because they make money at whatever they're doing, right? So if they didn't make the monthly cash flow, they lost the 25,000 or something happened, they can make the more money. I think most of it comes down to is they're afraid of they've been talking to other people saying they're going to get in investing, and then if the deal goes bad, I think they're it's more psychological on themselves that, hey, like I'm feeling I bought the wrong deal. Not necessarily they lost dollar amounts. It's more that psychologically they made a decision, they failed, and they other people are gonna think that they're a failure. Which the older I get, and you've done this way earlier than me, is like the less I care about other people. So and maybe that's one of the first steps, part of going from a wannabe to an actual investor is stop thinking about what other people think of you, do what you want, and then start making these investments.
So you go from a wannabe investor, you buy a rental. Maybe it goes well. Maybe it's a learning lesson. It should be a learning lesson either way. Then
Mhm.
you're a newbie investor. Maybe you have a few rentals. What are the biggest takeaways people should get during that time period? They've got maybe 1 to 2 rental properties. They're figuring
Mhm.
it out. They've been doing this for a couple of years. Maybe they got a duplex, they live in it, rent out the other side. 2 years later, they buy another duplex. What should be the biggest takeaways in those years to move on to more of a amateur experienced investor?
The number one thing is proof of concept, meaning after you get into typically in the first one, it's a house hack. So you're a lot of times not necessarily cash flowing. You're just lowering your cost structure. As you get into say that second, third, that's your proof of concept. So you found the deal, you bought the deal, you've got, you're renting it or short-term renting, whatever that thing is, you're operating your plan, and then you're seeing the money come in, you're doing the bookkeeping, you're doing your taxes, you're seeing rent increases. That's the biggest thing, this proof of concept. Because once you see that, then it's like, if I just do this every year, every other year, whatever your cash flow cycle is, you then can see there is a light at the end of the tunnel. Because if let's just say I'm making this up, $500 for that first property you buy. Now, if you need $5,000, okay, you only need 10 properties. If that's one property a year or one property every other year, there's an end date that you can see. And typically it ends up compressing because you get smarter, you make more money, you can cash out refi, you get debt pay down, you get your appreciation on all that.
And it may not even need that because maybe it's by the time you get your sixth property, the rent increases on the first two are
Hmm.
so big that you can walk away. Because 10 properties might seem daunting to someone. I don't know that
Hmm.
you need 10 properties. I don't know if Dion has 10 properties. I know he has over 10 rentals.
I think he was at, gosh, was it eight? I think it's 8 and 18 or something like that. And he cash flows like crazy. I want to say it's like over 1,000 a unit.
Yeah, he's last I heard it was like 21 grand a month, quarter
Hmm.
mil a year.
Yeah. So
Doesn't
he's got to
suck
be
for
like,
8 properties.
yeah, he's got to be at 1,200 ish a property then, 1,250 maybe.
Yeah, he's doing really good. But that just comes from time in the business. So
Hmm.
as you graduate and more time passes, some of your beginner deals that might have felt like a mistake at the time, you only cash flowed a couple $100, or you got to house hack and live for free or close to
Hmm.
free or cheaper than rent, whatever it may be. Those deals with time can become massive winners. Have you had any
Right.
deals that are like that where you got into it and it's like, oh, this is all right. And it just starts ripping as time goes on?
For me, like my best deal was actually my first deal. Could have been dumb luck, but the it I moved in and obviously it lowered my cost structure. I think when I first moved in, I was paying like net 700 a month. But prior to that, I want to say I was like 2,000 a month in rent. So like perfect, lowered the cost structure. Then over time, as I started changing the bottom unit from, it was a duplex, bottom unit from a long term to a short term, then COVID, then I switched it to a medium term. Then I started renting the parking lot. I mean, that one property, in the peak of the summer, I'll make over 5,000 a month on one. And the end game is I can build, and today I can do at least 8 more houses on the lot. So, that has massive upside to it. And just time holding these properties, specifically that one, just improves the returns on this property. It's just massive. Um, I would say, I'm on the more riskier side, and I think you're the same way. Where I there's been other deals where I bet on myself, where it's like, man, if this thing is basically break even today, like I know it with a very little down. I've done deals where it's literally zero down, where every month the out of pocket's negative, but my debt pay down is the same. So effectively, my net worth is zero, and I zero down, and net worth is zero. I'm like, but if I just can control more and more of these assets over time, I'm okay with it. That was in my rapid growth phase. Now, as we're talking about evolution, I'm less, apt to take those ones unless I can actually cash flow out of the gate. What ends up happening if you do a bunch of high risk on or high lever, you can
Hmm.
use the same definition on some of these. If everything's going well, everything's going well. But you can have a couple issues happen at the same time. If you have a high risk, high debt level, a couple of these go sideways at the same time. That's when you run into issues. That could be a massive liquidity crunch. And so, which I've been there in the past. And now that I've been there, I'm like, I don't ever want to be there again. So I'm less apt to take these riskier projects in later phases in my investing journey. And I would imagine that most investors that have, on the other side of having to work a day job, they're in the same boat because once you get out, you never want to go back.
Once you're more of a seasoned investor, you start making a little different decisions. Because what got you to
Hmm.
where you're at, it's not necessarily what's going to get you to the next level. Do you have a minimum cash flow per property target? Because some of the people I look up to, even though I don't want to build the business that they built, I look up to Grant Cardone still on a handful of things. I've kind of fallen off
Hmm.
that bandwagon over the years. But one of the things that he brings up is you shouldn't buy a property once you're established unless it cash flow. And he doesn't say once you're established. I think it should be once you're established. That cash flow is less than 2 grand a month. Because why are you going to
Hmm.
do all the work to make less than 24 grand a year today?
Hmm.
And as a seasoned investor, you could make a claim like that. Maybe starting out, that wouldn't be very smart. But what are your thoughts on that? Do you have a cash flow goal of like, I won't buy anything that cash flows less than 1,000 now that you're established, or maybe it's 2,000, or what's worth your time?
I haven't got one like, because like I was saying, I'm in the shrinking phase. I would say as I move forward and, as I was reading, a lot of the books were like, yeah, with real estate, you can be better than the stock market. So in my mind, it's more like a percent thing. So like if you could get a 10% cash on cash. Now, if 10% cash on cash and you cash flow $50 a month, then it comes down to, is that worth your time? So I get what you're saying there. There's like a percent, and then there's also a dollar amount. So, God, I'd love to be in the Dion where I don't do a deal unless it generates $1,000 a month or 10%. To me that makes it, to me that's like almost like a no brainer. Like why would you not do the deal, right? So um, if it's a long term rental, it's that's one I'll have to get back to you on it because I know like recently I did a deal that wasn't 10%. It wasn't 1,000, but it was one of those where it was low dollar entry point and there's upside to it, right? So I don't have a defined answer, and that's probably 100% why I'm where I'm at. To be honest with you, it's why I'm in multiple states and different types of assets and small multi and um, short term, medium term, long term parking and all that. So I think as you evolve, from where I'm at now, it's like honing into like what do I want to be really good at. So what I want to do more of is these single family, with incremental development stuff because that takes your downside away with massive upside. Um, so I didn't answer your question, but
That's fine.
if I
The
had
thought
to
pr-
give you one, it'd be 10% and $1,000 seems like a good metric.
it's great. And I don't even care about cash on cash return. I mean, you should look at it, but I'd rather earn 4% on a deal and have a really stable asset, good cash flow, than earn 10% on a not so stable deal in a bad market. Speaking of
I've learned
market,
oh, I was gonna piggyback on that.
go
What
ahead.
I've learned from you, and because you've spent a lot of years on larger deals, right? So when you're dealing with these larger deals, everything's based on NOI and debt service coverage ratio. The more I talk to you, the more I start thinking about debt service coverage ratio. Because what I'm hearing you say is like a, a deal that cash flows and is more conservative. What I'm hearing you say, based on our conversations in the past, is that instead of a 1.25, that might be a 1.4, 1.5, a higher and higher and higher debt service coverage ratio. The cash flow may not be as high, but if I have a high debt service coverage ratio, that's a safer bet on these commercial properties. Is that a fair statement?
Well, yeah, and when you're looking at it, the debt coverage ratio just helps you establish risk. As long as your debt is long term and fixed rate. If your debt payment is 10 grand a month and you have a 1.5 debt coverage ratio, what that says is you've got 5 grand a month, half of your debt payment is cash flow.
Hmm.
And that means every 2 months you can save an extra mortgage payment into reserve. A lot of banks will run it as low as 1.2, meaning that it would take you 5 months to save an extra mortgage payment. That's brutal. That takes a long time to build reserves. So yeah, your debt coverage ratio is very important. And on really small deals, even more so than your debt coverage ratio, you still want to have a certain cash flow number because if your debt payment is 1,000 and your NOI is 1,500, you cash flow 500, you got a 1.5 debt coverage ratio, but $500 of cash flow can still get eaten up, as you and I both know, very
Whether it's
quickly.
that property or another property, right? So
Oh yeah,
yeah.
Flavio asked you a question. How do you see the market in Yakima? I see a lot of deals there.
See, I like Yak. I only have one like what I call Frankenstein building. It's a 6 unit, one large house. It was chopped up. It's been steady Eddie for me. After so that was a creative high risk deal where I ended up getting it off Craigslist, low down, wraparound mortgage, fixed it up, refinanced out. But when I bought it, there was a druggie in one of the units. But after I did add, which is brain damage for about a year, it's been steady Eddie for like 3 years. I mean, maybe, so there's 6 units. I think one unit turns a year, which, is, and the people that are in there now, like I'm just doing the small incremental, because I went to market and now I'm just doing small incremental raises. So I like Yakima. It seems to be steady Eddie. Property management group that I have there, I honestly don't even spend much time on it at all. It just kind of money goes, all the stuff is like almost auto flow. The rents come into the property manager, they pay the bills, I get the money, auto insurance payment, auto debt payment. It's like I don't know about it almost because it's just steady Eddie. I think over time I'm going to buy more in Yakima. It's just that I've been focused on 1 hour Seattle. So I haven't really looked at Yakima to buy in probably 6, 12 months.
When you buy there again, assuming you do, what type of asset are you going to buy? Are you going to buy another Frankenstein place, or are you going to buy traditional apartments? Are you going to buy residential? The reason I'm asking is Flavio is based out of that area. He's not in Yakima specifically, and I guess since he did put it in the chat, I can say it because he puts it in the chat every week. I didn't want to like put him on blast, but Grandview is pretty close to Sunnyside, close to
Mhm.
Yakima, so all those areas. He could go build a good sized portfolio over there. He's doing a bunch of cash out refinances, DSCR loans right now.
Mhm.
If you were in his shoes, let's say you have a few hundred grand liquid that you're pulling out of assets, what would you be looking at in that area?
In that area, I'd be doing multifamily. I like it out there and there's actually quite a few. My brother lives over there, so I'm going over to see the nieces and nephew, usually like at least every other month. And there's a bunch of these small mobile home parks over there. I'm like, man, and you can tell that they haven't been updated for like 20 years, man. And so I'm like, man, these seems very ripe to be able to buy and have a larger commercial asset that would cash flow. So I'd be looking at, I wouldn't do a Frankenstein house to answer your original question. I would try to get a larger multifamily building in a decent area and or one of these small mobile home mom and pop parks, try to get one of those deals.
Love it. And do you have a time constraint here? You got to hop off in a minute.
Yes.
All right. Well, we're gonna let you get to your party boat. Enjoy your time. We're gonna keep doing this every week. Yeah.
Yes, sir. Every Wednesday. Next Wednesday, I'll be in Breckenridge. So I'll have to double check, make sure that I can get the call in before we're heading back to the airport next Wednesday. So, but looking forward to having these every Wednesday, man. Appreciate the time.
All righty.